All right, let's jump right into this explainer. Welcome. So, if you've spent literally any time navigating the financial markets, you know exactly how thrilling it can be to spot a great entry. But you also definitely know the universal, downright agonizing struggle of trying to time your trade exits perfectly. Getting into a trade? Well, that's only half the battle. Knowing exactly when to get out is what actually determines if you walk away with money or just a really frustrating story.
So let's kick things off with a question that probably hits a little too close to home. Why do most traders exit winning trades too early? You've likely experienced this yourself, right? You watch a green position suddenly flash red because of some random market volatility, or you feel the deep emotional pain of giving back profits that were sitting right there in your account just an hour ago. That emotional roller coaster makes us do some pretty irrational things.
Believe it or not, this irrational behavior actually has an official name, the disposition effect. It is a massive psychological trap. Basically, we sell our winners prematurely just to lock in a feeling of success while we stubbornly hold on to our losers, hopelessly praying they'll magically bounce back. Fundamentally, this is driven by fear. The fear of missing out on a gain or the fear of admitting we were wrong pushes us to make terrible, emotion-based decisions rather than strategic ones.
And the traps don't stop there. Honestly, our brains are actively wired to sabotage our trading success. First, we have loss aversion, where taking a loss literally hurts us emotionally way more than a gain feels good. Then we have anchoring, where we get totally obsessed with our exact entry price. There's recency bias, which makes us panic over a tiny short-term dip even when the long-term trend is perfectly intact. We all suffer from overconfidence at times, and perhaps the absolute worst of all is the illusion of control, where we somehow think that intensely staring at a chart, sweating over every tick, gives us telekinetic powers over the price. Spoiler alert, it doesn't. It just leads to ruin.
So how do we actually protect ourselves from our own brains? Let's move into Section 1, the mechanics of exits, moving from emotion to structure.
Let's look at the two essential tools that make this possible. First up, the stop loss. Now, a stop loss isn't just a measure of your pain tolerance. It should be placed at the exact price level where your trade thesis is officially proven wrong. It triggers an automatic sell, effectively preventing a bad trade from turning into a catastrophic portfolio bleeder. On the flip side, we have the take profit. This is placed exactly where the trade has successfully played out according to your strategy. It automatically locks in your gains, completely protecting you from sudden, unpredictable market reversals. Together, these two orders convert discretionary gambling into a planned, bounded outcome.
And that brings us to what I consider an absolutely foundational rule of market execution. Top Wealth Trading puts it perfectly. Positions become trades when they have a plan. The crucial takeaway here is that before you ever even click the buy button, a disciplined trader already knows exactly where they are going to exit, both for a profit and for a loss. If you don't know both of those numbers up front, you don't have a trade. You just have a hopeful position.
But once we have a plan, the numbers actually have to back it up. Which brings us to Section 2, the golden ratio, math over myth. This math completely reframes what it actually means to be a successful trader. Just look at how your risk-to-reward ratio stacks up against the win rate you need just to break even. If you risk $1 to make $1, a standard 1-to-1 ratio, you have to be right more than 50% of the time just to cover your trading costs. But look at that bottom row. If you target a 1-to-3 ratio, meaning your take profit is literally 3 times larger than your stop loss, you only need to be right 25% of the time to be profitable. Think about that. You can lose 3 out of 4 trades and still make money. Mind-blowing, right?
So, how does this actually look in the real world? Well, let's walk through Rainer Thiel's step-by-step logic for a sideways range-bound market. Step 1, you find a market bouncing predictably between clear support and resistance. Step 2, you enter your trade right at that support level when you spot a valid bullish trigger. Step 3, here is where the structure comes in. You place your stop loss exactly one average true range, or ATR, below that support to account for normal market noise and volatility. And finally, Step 4, you place a fixed take-profit order just before the resistance level. Why right before? Because you want to lock in those gains before the inevitable heavy selling pressure steps in and ruins the party.
Of course, markets don't always move sideways. So let's look at Section 3, Advanced Target Strategies. This is all about scaling up your exits when you catch a massive breakout. When the price is just marching upward into complete uncharted territory, professional traders often rely on two kind of monolithic magic numbers, 1.382 and 1.618.
These are specific Fibonacci extensions, and they are basically brilliant tools for projecting profit targets that exist way beyond the current market price.
So how do you actually choose between the two? Well, it all comes down to the environment you're trading in. The 1.382 extension is your conservative target. You use this when the trend environment feels a bit weak, or if the initial pullback, the retracement, was really deep, which indicates a slight lack of momentum. On the flip side, if you are an aggressive trader operating in a wildly strong trending environment with short, snappy retracements, you aim higher. You target the 1.618 extension to fully maximize that momentum.
Now, another brilliant advanced exit tool is the trailing stop. But it comes with a pretty major dilemma. You absolutely have to know your market environment. If you are in a range market, whatever you do not use a trailing stop. The market will naturally chop up and down, and a trailing stop basically guarantees you're going to give back profit on every single normal reversal. Stick to fixed take profits there. However, in strong trending markets, trailing stops are absolutely incredible. By trailing your stop, let's say, 1 times the 14-period ATR behind the price, you capture monster gains without artificially capping your upside. It just automatically locks in your profit step by step as the trend climbs higher and higher.
Now, at this point, you might be thinking, well, surely multi-million-dollar trading algorithms have this perfectly figured out, right? Prepare to be surprised. Welcome to Section 4, the algorithmic blind spot, when machines exit too early.
To give this some real rigorous authority, let's dive into this fascinating academic paper from the Munich Personal Repack Archive. They analyzed algorithmic trading on decentralized exchanges, and these researchers identified a massive flaw in how we typically evaluate trade exits.
The researchers introduced a really clever methodology called counterfactual outcome measurement. In simple terms, what they did was put a real-world meme coin trading system into a sort of shadow mode. When the algorithm triggered a stop loss and exited a trade, the researchers didn't just stop tracking the asset. Nope, they actually followed up on those stopped-out positions hours later to see what would have happened if the machine just hadn't sold. They essentially tracked the winner-missed scenario.
And honestly, the findings from this experiment were genuinely surprising. First off, they proved that algorithms actually suffer from a massive structural blind spot because they only ever see their realized profit and loss. They never see the huge gains they missed out on by stopping out too early. Second, they found that a statistically notable proportion of those stopped-out positions actually recovered and went on to be highly profitable. This proved that even super advanced emotionless algorithmic systems exhibit oversensitivity in their exit logic. The ultimate takeaway here? Optimal timing is incredibly difficult, even for supercomputers, and safely testing your exit logic in a shadow mode is absolutely essential.
Which brings us to the ultimate question I want you to take away from this explainer today. Take a hard look at your own trading system. Will your next trade be driven by the fear in your gut while you nervously stare at a flickering screen? Or will it be driven by the disciplined, predetermined structure we've outlined today? By setting logical stop losses and mathematical take profits before you ever enter the market, you completely take the emotion out of the equation. Thank you so much for joining me on this explainer, and I challenge you, make your next exit a structured one.